I'm Matt Bichard with REIT.com here in San Francisco for REITWorld 2013. Joining me is Scott Schaevitz, the chairman of America's Real Estate Investment Banking Division with Barclays Capital. Scott, thanks so much for joining us.
Great to be here, Matt.
Has the level of M&A activity that we've seen so far in 2013 surprised you at all?
It really hasn't. Coming into 2013, we knew that there were a lot of non-traded REITs that had gone through their investment cycle. There were a lot of portfolios owned by private equity that were in the same situation. So we felt good about the supply that would be coming out. On the demand side, REITs were trading at nice premiums to NAV, giving companies a good currency to use for acquisitions, plus debt was inexpensive and the capital markets were open, so they had the available capital to go after deals.
And are there any sectors that you see more primed for public-to-public mergers?
It's interesting because over history we've seen certain sectors get hot. So you saw a wave of healthcare, real estate M&A, for example. This year we were involved in 3 net lease M&A transactions. However, I like to think of it more as a cost of capital issue versus a sector issue. What I mean by that is across any sector you can see a company that might have a very high cost of capital, may perennially trade at a discount to its NAV, and because of that has trouble competing against other companies in the sector. And those companies may decide over time to sell themselves versus trying to fight through that cost of capital burden. And so that's why I think that those companies can exist in any sector, and that's really where we see the opportunities.
And of course this year we've seen the IPO window open up a little bit for REITs. Are there any sectors where you're keeping your eye on, you think we may see some more companies come public?
I bifurcate the IPO market a bit. I think that on one hand you have smaller companies doing primarily retail distribution deals where institutions are not getting involved because the size is so small. Those companies tend to have less following after their IPO and tend to have a challenging cost of capital and sometimes difficulty raising additional capital to grow. On the other hand, you're seeing larger companies come out with this institutional support and the ability to keep growing their companies with efficient capital going forward. And so that's why we're seeing really a split in that market.
Scott, thank you so much for joining us today.
Pleasure.
For more from REITWorld 2013, be sure to visit REIT.com.